Well, hello again, everyone, and welcome to the Options Mentor. Well, what an interesting couple of weeks we've had with the market running up, and now the polish seems to be coming off of the S&P a little bit because they're now worried about rate hikes. You know, the Fed has always been very clear that they expect 2 more rate hikes this year, but I really think it seemed to take the Bank of England doing it, and then I believe some other chatter amongst European banks. Finally, I think our market's accepting the fact that we're not getting rate cuts this year, and we're probably getting more rate hikes, and maybe they shouldn't be quite so exuberant. But the interesting thing is, and here, let me share my screen with you. Very interesting thing is, even with that, even with the market coming off, here we are today, we're off 20 points, and the VIX itself is below 13. Below 13. The VIX continues to go down while the market goes down. Now, that's the opposite of what normally should happen. Normally, when the market goes down, since most market participants are long, there's a panic that ensues when the market goes down. They buy puts, sell calls, which drives up the VIX level. But in this case, the market's going down and the VIX is going down, or at least not going up much. And we can see here, we're at about 4.5-year lows since we've been this low here, below 13 on the VIX. So what does this say to me? This is bright lights, if we're down here, that we need to do some long Vega trades. So let's look at kind of a modification to what we've been doing here. I'm going to go over here to the SPX. And you can see here that I have modeled a calendar that is for a week from 2 weeks from today. Actually, I wouldn't put this trade on until Monday. Just want to be clear. Or Tuesday, Monday, Tuesday, or any day next week, you could put this trade on. But it is for the following Friday, a week from next Friday. So next Friday is the 30th. This one's for July the 7th. And it is right around the money here calendar. You could do calls or puts. But let's look at something here. This is 3 days wide between the short and the long, which is what we've been normally doing. Cost about $2.80. Your Vega is around $33 or 33 points here. But if we went out 5 days to July the 12th, 5 days, now we have our Vega go all the way up to 54. So I kind of like this idea. Why? Because we're at 4.5-year lows in the VIX in the face of an economy and a Fed situation that doesn't warrant it. So I look for volatility to stay firm, to go higher. I'm not particularly worried that a week from today we'll be down underneath 11 or something. I just don't see it. Could we go a little lower towards 12? Well, sure. But I think that most of the VIX decline, at least in the short term, is probably in. That's why I want to get long Vega. So going into next week on Monday, Tuesday, if we're still down here, particularly if we're under 12 or under 13, then, or even under 13.5, I'm going to be looking to put on a calendar like this for the following week that is 5 days wide between the short and the long. Now, also, it does cost you more, right? If we look here, it's 755-ish. If I do 5 days, excuse me, and 3 days would be 250. So you're going to pay a lot more for it, but you will also get faster time decay. And the reason for that is your long is expiring slower, right? One of the ways calendars work is that the short is expiring before the long, so it's rapidly losing its time value more than the long is. Well, if you put the long 5 days out instead of 3, I know it doesn't sound like a lot, but even that will increase your theta coming into your account. And I believe if you put this thing on, say, Monday, you should be out of this at 10% unless we have a huge move. I think by the end of the week, if you're not, that's fine. You can take it into next week. But I look for this to work pretty well if we go into Monday with a really low volatility. Again, something under, 13.5 and under, certainly under 13, where we're at now, 12.99. So this is the kind of trade that I'm looking to do. Long Vega. You could also consider the long diagonals and double long diagonals that we talked about. But I really like this calendar and going out 5 days wide between the short and the long. Now, if you do a long diagonal or a double long diagonal, I still stick with the 3 days because they get very expensive if you do 5 days. So just stick with the 3s if you're doing that long Vega trade. And with this trade, let's go ahead and go out to 5 days between the short and the long. Now, if there's some reason you don't want to do that, you could still do 3. I just like the idea of getting long Vega here. I know summertime can be very sleepy and complacent, but I think we've overdone it here as a market. And I do believe volatility will rise here in the near term. So once again, I really appreciate you guys supporting my channel. Please like and subscribe to my channel. Tell your friends. We are growing here pretty rapidly. I love the comments. I've been getting back with those. So if you have comments, put them in down under the video. I'll get back with you, answer questions or what have you. And I look forward to this channel growing and our knowledge together growing as income option traders trying to get the most out of these leveraged instruments. So have a great weekend, folks, and I will talk with you next week. Bye-bye.